Take a look at Treasury yields right now. We're looking at the 10-year note at about 4.533, the 2-year at 4.2. Our next guest says the biggest risk to the bond market right now is a reacceleration of inflation and wages that could then lead to rate hikes being considered. Kelsey Berro is here, fixed income portfolio manager, JPMorgan Asset Management. We've been trying to decipher what Mr. Powell may or may not do. And Becky was just mentioning him in the last segment. And I think this may be the first time we've had this because he sort of said he wouldn't do this. He seems to be considering the prospect of tariffs and other things even before they happen, right? We've sort of gone back and forth of, when, if you're the Fed, are you supposed to consider things that haven't happened yet? Mm-hmm. How does that play into all of this for you?
So I think the Fed is in a decent position because they were able to cut rates 100 basis points last year. They were able to reduce the amount of policy restrictiveness in the economy, kind of take the edge off, keep things moving, keep the labor market strong. And now they're really, I think, very comfortable staying on hold for an extended period of time so they can get more information, whether it be on tariffs, whether it be just on the standard flow of economic data. So you have the inflation data this morning we're getting, the PCE inflation report, as well as the ECI wage data. So I think right now what they're trying to do is stay on hold. And in this case, boring is kind of beautiful for the Fed.
So you have a view, though. I mean, let's take it step by step. We also have so many different fiscal issues that are going to happen later this year in terms of what the bond market may or may not do to Washington. How does Jay Powell sort of navigate that?
So I think for Jay Powell, it all comes back to their dual mandate of maximum employment and price level stability. The labor market has been strong. There were downside risks to the labor market. Those have primarily abated. So it really all comes down to inflation making further progress. Now, I think the Fed, their baseline when they enter each meeting this year, they're really considering two options. One is to hold, just stay pat. Right. Policy is fairly well calibrated. The other option is to cut rates if, one, inflation progress proceeds, or they start to see labor market weakness. Right. The inflation part is very challenging for them because they have the domestic inflation, the more demand-oriented cyclical inflation that they care a lot about. Right. And then on the other hand, they have tariffs, what they generally view as a one-time price shock that has an offsetting impact of weaker demand.
Where do you think we really are on inflation at this point?
Well, right now, core PCE on a year-over-year basis is at 2.8%. What I like to look at, though, is the 3- and the 6-month run rate. Those are actually around 2.2 to 2.3%. So actually really not that far away from the Fed's goal. We're not in a below 2% inflation world. That's where we were pre-COVID. Right. We are comfortably in a 2 to 3% inflation world is really where I see it. And the thing that gives me comfort that we're not yet seeing a reacceleration in inflation is the wage picture. So if there was anything that I'd be looking at to determine that actually things are tightening back up, the Fed needs to reconsider hikes, it's if we start to see wage data really start to turn the other way. Right now, we've shifted from an environment where the labor or the worker had a lot of power in 2022 and 2020 in terms of bargaining power. That's gone away. We need to see where that moves over the next year.
Base case for you, where is the 10-year and the 2-year a year from now?
I think it's probably around these levels because I do think we are kind of in an extended pause. And I think what we think...
For a year, okay.
You think that because the Fed doesn't change its stance on anything, or you think that because you also don't see pressure from bond market, from Treasury buyers?
So I think that the buyers are going to remain, but at the same time, you are going to have the Fed that remains on hold. And ultimately, the Fed is going to be one of the primary drivers of yields. So I think that what we have right now is an environment that's not too hot or not too cold. But for investors, this is actually quite a good environment. We call this a carry environment, an environment where, with yields relatively stable, what you can expect in terms of your returns from your bond portfolio will be fairly equal to the starting yield in which you invest. So if you're investing in a bond portfolio right now, around 5 to 6% on core, 7 to 9% on high yield, if yields stay around here, your returns are going to be similar to those yield levels. And those are returns that we think are actually quite attractive in this general environment.